Hello everybody, this is Kian from cryptobulls. Hope you're having a great day wherever you are. Today we're going to talk about crypto trading 101, introduction to exponential moving averages, entries and exits. I'll show you how to set it up, and I'll explain you how you can implement these strategies, these indicators into your investment, either for day trading or long-term investments. For both cases, they're very powerful strategies. So first of all, we'll look at EMA as a trading strategy. We'll understand the different moving averages, the significance of moving averages and exponential moving averages, how to spot the buy signals and the sell signals, and one of the weaknesses of the EMA trading strategy. And that at the end I'll show you a small indicator that you can use in TradingView, which I believe is very powerful and helps you have an overview on the current state of the market. So let's get started. Keep it simple. Exponential moving averages more or less are lines, and each line has the same base calculation, and the only difference at the end is the amount of candles that you use. So for example, an EMA that has got the number 20, you're going to be using the last 20 candles. An EMA that has 50, you're going to be using the last 50 candles, and so on. So it doesn't really matter which time frame you're on. So traders all over the world enter the market with the sole purpose of turning a profit, and many analysts like to use trading strategy, like to use moving averages as one of their indicators, since they are so powerful and they're very easily added to charts. But now I think it's important that we understand what moving average are. So a moving average is a line derived from a mathematical formula that averages a given set of price points drawn from a specific time period. So price points is opening and closing prices. That's how candlesticks are drawn. So a 20-day moving average, for example, will average the closing price of the last 20 trading days of a token in focus. So the good thing is it doesn't have to be the closing price only. So moving averages can be fine-tuned to base the averages on either close, open, high, low, or even medium prices. You can select which prices you want to choose, and this flexibility is what makes this tool very attractive to professional traders or long-term investors. A moving average that is weighted equally across all periods is called the simple moving average, SMA, and this is the foundation of all the variations of moving averages. For one which we are looking at today is the exponential moving average. The EMA formula, so the exponential moving average today, the dots on the chart that makes the line of today, equal value of today times smoothing divided by 1 plus days, and the smoothing is a factor, and that you add plus the exponential moving average of yesterday times 1 minus smoothing divided by 1 plus days. So you always look at the exponential moving average from the last day and the last day before, and that's why it's the exponential moving average. So the closer you are to the current day, the more affected it will be from the current price change. And to compare, when you compare the exponential moving average with the simple moving average, then exponential moving average is much more, if you look at a short period of time, the reaction of the curve will be much higher. So it will be much higher towards the higher side if the price rises, and it will slope down much faster to the lower side when the price sinks. So the EMA has a fast response time because of the multiplier effect used when calculating it. It differs from the SMA because emphasis is laid more on recent prices and weighted accordingly. When used as a strategy, very often use 3 different exponential moving averages together, and they can be very effective in a single chart because what we want to look at is when the exponential moving averages cross. So when the shortest of the moving averages is at the top, and then the bit higher one is a bit underneath the first one. Let's turn this off, sorry about that. So for example, we've got here 5, 10, 20, 15, 100 moving average. When the moving average with the number 5 is all at the top of the chart, and then there comes a 10 underneath and a 20 underneath that, then we're going to be in the bull market, or the prices are rising accordingly. I'll show you that on the chart, since that might be easier to visualize than just talking about these numbers like that. So when 3 EMAs are used as a strategy, the longer time frame, like the 200 EMA, is used for a trend definition. That's for a long-term trend. So here's an example with the exponential moving averages. On this chart, we've got the 20 EMA is white, the 50 EMA is red, and the 200 EMA, which is dark blue, here below. As you can see, what I tried to explain before is, as long as the 20 EMA is above the 50 EMA and above the 200 EMA, then we'll be in a upwards trend. As soon as there's a crossover, the first crossover will be between the first two moving averages. So here the 20 EMA crosses over with the 50 EMA, and that might be a first indicator to exit a trade. However, one of the downsides, which we will look into more detail afterwards, is when we're in sideways movements. So as long as we're going up, we can use these EMAs as support levels to maybe add to our position while going up. When prices are rallying, the 200 EMA will act as main support line. Buy entries are initiated only if the 20 EMA crossover and trend above the 50 EMA. So here we would have the buy signal, since the 20 EMA crosses over the 50 EMA. And in this case, only at the beginning we've got some touch points with the 200 EMA, and afterwards it leaves and only touches the 200 EMA much further in the timeline. However, we've got this exit buy here, which is a signal to exit the market. Sell entries. Here are a few more examples with sell entries. In this case, would be a bearish scenario with the 200 EMA at the top of the chart. We're going to have the red, the 50 EMA is sandwiched between the 200 and the 20 EMA. So what often happens is that the 20 and the 50 EMA during a bear trend will be crossing over or touching on sometimes small crossovers, or touching, however, only as soon as it touches the 200 EMA, traders might consider a reversal possible. It's important to make sure that you don't just focus on the 20 and the 50 EMA for long-term investments, as the indicator it's not reliable for, it's more like reliable for short-term trend reversal, but not for long-term trend reversals. Another one of the downsides of the indicator is very often that if you would only use this indicator, you wouldn't sell at the complete top and you wouldn't buy the complete bottom, because especially if you use the 200 EMA for your signals to buy or sell, then you will be losing out on a lot of profit. Here as an example, of course, here you would have bought, since it probably crossed over a bit before, and it crosses over much later. So you would have maybe sold at around 13,000 when it crosses over, and that's why it's probably not the best idea to only use this indicator for your trading. weaknesses of the EMA trading strategy. Remember, first of all, that there's no one strategy that rules them all. You should use them in combination with other strategies such as relative strength index or the Ichimoku cloud. However, the Ichimoku cloud has its own version of exponential moving average, so there might be that might not be a good idea. Strike that. Anyway, let's head over to the BTC USD chart, and here I'm going to quick show you the different moving averages that you can add. So here I've got an exponential moving average. What you can do is you can click here on the indicators and you can select EMA, and you've got your moving average exponential. You can click on it. I've already got it, and we'll click on the cogwheel, and here you can select, first of all, you can select the color and the input length. So this is basically the amount of candles that you want to calculate, to the time period, or the candle period exactly. And here I've got another EMA, exponential moving average, with a candle period of 50. Now, as a small bonus, since even though the exponential moving averages are fun to use, I discovered one. It's called MMAR, and basically what it does is it's like a grid of exponential moving averages, and you can visualize the crossover very easy. So here you've got one crossover, and you can also visualize when the crossover is happening. So if we look at the BTC USD all-time high moment, that was in mid-December, and we've got the MR that is starting to cross over. So basically here, with this complete crossover, would have been a good time to exit your position, even though you might have not be selling at the complete top at 19,000. However, you would have exited your position at $10,700 more or less, and that would have been the case. You might have thought about going back into position here. However, at the next crossover, you would have sold again with a little bit of loss, and that's how you can use this small indicator to help your overall long-term investment. Now, as you can see here, we've got a crossover again, which is a good signal that there's a lot of potential of a bull market to start. So I wouldn't be waiting on any dips to accumulate. I would just dollar cost average based on RSI, or just dollar cost average onto a certain price amount that you're comfortable with. However, when we're moving sideways, very often what happens is that these crossovers will happen very often. So I would maybe refrain from exiting the position during a crossover, during the accumulation phase, so when it's on a sideways channel, and just focus on accumulating if you intend on gaining more cryptocurrency. So that was about it for exponential moving averages. I hope you learned something new and you can use it in your investing. Hopefully that will help you find better entries and buy the dips instead of the tops, and that's what everyone wants. That's it. Have a nice day. Thanks for listening, and catch you on the next one. Bye bye.